Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as wealth advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm Steve Sandusky. And as always, I have my co-hosts with me, Bill Keen and Matt Wilson. Gentlemen, how are you on this fine day?
Well, we're doing good this time of year. Taxes have been taken care of, filed. All that behind me now. Steve, how about you? Have you got your taxes filed, or are you extending this year?
Most likely extending, and my tax people just take care of it. I have not seen a draft of it yet either. But that's going to have to happen here pretty quickly for sure.
Okay. Are you one of those that likes to get a refund, or do you like to have to pay a little bit at the end?
I try to balance it so that I am neither a payer or an ower. So yeah.
Okay.
Not one who likes surprises that way.
Yeah.
Yes, and you don't
want to give the government an interest-free loan. But
yes.
Then also don't want to have to write a big check either, even though technically the government would give me an interest-free loan if I owed a bunch of money. So just try to pay my fair share along the way.
Okay. I think that's a fair position.
And you're
Matt?
required to.
Yes.
They penalize you
not that I have a choice.
Yeah.
Taxes at this point are not optional.
Yes. Those darn penalties too that they impose.
Maybe for some people they're optional, but not for
not everyone has to file a tax return. Of course, if you don't have any income, that generally exempts you from having to file a tax return. So
right. Yes.
Speaking of taxes, I mean, we are, coming up here. This is being released. Taxes are due to be in for everyone, at least on the April 15th date here coming up. Would be the next week after we're releasing this show. And I think you might have had kind of an interesting tax fact for us to start our program today. Is that right?
Yeah. Well, if you want to consider tariffs to be taxes, some people definitely consider a tariff to be a tax. But I thought this would be kind of fun. I think, all heard the phrase banana republic. And
is that where I got my clothes when I was younger? There was a nice store down here in the plaza here in Kansas City.
Now you're really taking this in a direction I hadn't planned on, Bill.
Is that what Banana Republic? Oh yeah, there was some cool
the
stuff
retail
down
store.
There.
Yeah.
I think are still in business, Matt? Do you know?
Yeah.
Okay, good. I think the Gap might have owned them. Is that true? Is that right?
Possibly.
Is it possible? Okay.
So do either of you, excluding the retail store Banana Republic, either of you have any idea how the term Banana Republic originated? And before you answer that, let's start off with a definition of Banana Republic. So how would you guys define Banana Republic?
I suppose a country that had some like lax laws, maybe corruption, things like that. Generally speaking, is that close?
Close, yeah. So it actually is. As I was researching this, it turns out to have a fairly fascinating history. So the term was first coined by American writer O. Henry, a popular writer for sure, in a book that he wrote in 1904 called Cabbages and Kings. And it was inspired by his experiences in Honduras. And what it ultimately came to describe are countries typically in Central America and the Caribbean area whose economies became heavily dependent on banana exports, particularly to the United States. And so what happened was those countries ended up getting preferential tariff agreements on their banana exports. And so they ended up concentrating a lot of their economy in banana farming. And then some of the other farming that was available, some large U.S. companies came in and were able to do some of the other farming for other types of fruits and produce. And those companies ended up getting some pretty good control over those countries. And so what ultimately happened was, if your economy is very focused on like one particular type of farming, well, what happens if you have a bad year or a bad crop or something like that? well, then your economic results obviously can fluctuate pretty significantly. So over time, the term banana republic has evolved to really more generally describe any politically unstable country or any economy that might be dependent on exporting a limited type of resource. And also countries that also have a very sort of stratified wealth culture, where there might be a small number of people that are very wealthy and a large number of people that are not so wealthy. So yeah, so Banana Republic got a little history there as a result of tariffs.
Yeah, that's interesting. It sounds like, Steve, that countries would benefit from diversification just like people's portfolios do.
Matt, that is so astute.
Yes.
Which leads us, I think, into today's conversation. So we're going to do a case study here, and we had a situation arise here, or a listener question actually, and we're going to give some of the details here of this particular case, and we're going to go through that. And I think it's extremely timely with what's going on in the markets these days. So here's the situation. We've got a couple, Jim and Karen. Jim is 66, Karen is 64. They both retired within the past 6 months, and they also sent along some of their assets. So they have a net worth of $2.7 million. And then on the asset side here, Jim has an IRA of $900,000. Karen has a Roth IRA with $300,000 in it. They have an inherited brokerage account with $600,000. It has a cost basis of $500,000, and they have a cash fund or emergency fund of $100,000. So Matt, they have some assets here.
Yeah. I mean, that's definitely good. You know, when we hear net worth, it's always, well, how's that made up? Because for the most part, it's liquid assets or illiquid assets. And, in some cases it can be a lot of illiquid assets, and that can make it difficult from a retirement income generation because, well, you have to sell something if it doesn't generate much income or no income. Whereas the balance of their net worth is primarily in liquid assets, which would definitely be beneficial to them for generating retirement income.
Yep. And then they also said that they have a home that is valued at $750,000. It's paid off, so there's no mortgage there. They have no other real estate. They have no other debt. They do have access to a home equity line of credit for $250,000, but they have not tapped into that at this point. In terms of their income sources, Jim is receiving Social Security of $2,600 per month. Karen's Social Security will start at age 67, so she's not getting that yet, but that'll be about $1,900 per month. And then Jim has a pension of $1,800 per month, and there's no cost of living adjustment to that. So got some nice income coming in here.
Yeah. I mean, you add all that up, and it's just over $75,000 coming in on an annual basis, which is nice. That's great. I mean, you've got Social Security, which about $4,500 of it once it's on for both of them. And as we know, Social Security currently has a cost of living increase each year. And yeah, Jim's pension, while no cost of living increase, still $1,800 a month. Very, very nice benefit.
Mm-hmm. Oh, yeah. Yes. And then on the Medicare side, Jim is enrolled in Medicare, and Karen will enroll when she turns 65. The monthly premium there is $185 per month, and plus a Medigap Advantage plan. And then Karen is paying $600 per month for her health insurance because she's not on Medicare yet. She's about 6 months away from that. And then in terms of spending needs, they're saying about $100,000 per year is what they are spending. And that would be net of taxes, plus they need to add healthcare on top of that. And then they have a couple other spending goals that they would like to do. And one of them is remodeling their home. And they'd like to do that in 2026. And they're expecting that might cost about $100,000. And then they also want to plan for travel, and they want to budget $20,000 per year for travel in each of the next 10 years. So what are you guys thinking here in terms of they're a little concerned with market volatility? Maybe they retired too soon. Maybe they should go back to work. Obviously, this is a perfect example of what a financial planner can help you with, because you guys can do some math, you can ask some questions and really walk through. So where would you start here?
Sure. I mean, first and foremost, I mean, it's common for people to feel this way, especially, they retired within the last 6 months. And, if you go back 6 months, it's like, okay, that was basically when the election happened and the market ran up until early February and not a whole lot of volatility. And then all of a sudden, we're seeing some volatility here. So it's common for people to be concerned, especially that new in retirement, thinking, oh gosh, they don't like to see the balances fluctuate very much. No one does, but it's part of the process. Looking at the makeup of their assets too, they've got a lot of flexibility, which is a big benefit to them because, they have, they have their IRA. Jim's 900,000. Karen's is a Roth IRA, so that's tax free, which is great. The inherited brokerage account. So the basis, Steve, you mentioned, was $500,000. So they have a capital gain. We don't know if it's long-term, short-term, but a capital gain. I'm assuming it's going to be long-term here soon. If it's not, of $100,000, but they have access to $500,000 with no gains. So a lot of flexibility there. And of course, then the cash reserve. So they've set themselves up very well for retirement. You factor in then the Social Securities and pensions and $100,000 net of taxes, plus the healthcare on top of that, is definitely something that I think is doable, just looking at it from, the back of the napkin. But what I think we could do is we could walk through, well, let's plug it in to our financial planning tools and kind of talk through what is it that, one, ultimately, what are they afraid of? Yes, I mean, they're commenting on the market, but for the most part, a lot of this stems in, well, they're afraid of running out of money or having a significant change in their lifestyle. Because is this the start of some massive bear market that's going to last a long time? I mean, you just don't know. Just when you start seeing it go down, it's easy to extrapolate those negative returns into, basically down to zero. I mean, some people, I remember this during 2008, 2009, when, markets were very difficult for a long time. And people would say, well, this just keeps happening, I'm going to be out of money in 8 months. And it's like, well, sure, based on the math, but that's assuming it just keeps compounding lower and lower, which doesn't happen. So far, history has proven that the market's a diversified portfolio. The indices, like we say, Dow Jones and S&P 500, have not gone to zero. They have not. So, we've got that on our side.
We call that, in fact, we did a show on this several episodes ago. We call that almost need or that desire to want to extrapolate what's happened most recently into the future indefinitely. A human bias, we call it the recency bias. You think whatever's happened most recently is most likely to happen indefinitely. And we know that's not true. Now, in this case, we're talking about things we say volatility. Well, volatility means price action when we're talking about the markets around a kind of a mean. Well, volatility could be higher as well. Like, oh, it went high. It went up a lot. Well, that's volatile. Well, no one's worried about that. People like when it's volatile on the upside. But when typically when we speak about volatility, we mean we're seeing a little downward corrective action. And but it could work either way. So we want to make sure folks have a real valid and educated thought about how these things play out over trend lines over time over their life. Because going back to work after someone has just retired from a long career, in some cases, maybe they could go back and consult or find jobs that were close to what they were making before. In other cases, it's not the case. If you've left a job you've been at for a long time, it might be difficult to go back into the workforce at that same level. And so that's a dramatic thought, and to honor and acknowledge the anxiety around this Jim and Karen's question, I think, is important, and to be able to walk through why the answer, in our opinion, will be no, they don't have to go back to work, assuming things are set up appropriately. And I know we'll get into talking about their asset allocation as well, how things are invested, in addition to the different case facts that you read there, Steve.
Yeah. Well, I'm really curious how you approach this from two angles. So one angle is what the numbers say. So you run it through the financial planning software and it comes back and it says, oh, you're pretty good. You've got an 87% confidence level that you're not going to run out of money based on this scenario. And to some people, that gives them comfort. But other people, there's more of the emotional factor in it as well. And even if it said 99% confidence, they might be focused on the 1% non-confidence
Yes.
or the 1% probability that, quote, we're not going to hit our plan here. How do you address the psychological side of sort of the fear factor here of someone who might be presented with, hey, you're fine, but psychologically they're still not fine? How do you address that?
Mm-hmm. Yeah, there's several ways that we discuss it, because it's we want to put it in context of how distributions are taken from the portfolio and what things are being sold to, to generate the income if just the dividends and interest aren't sufficient to cover it. And to what Bill was mentioning earlier about their asset allocation, like we don't know how their funds are invested. They could be 100% equities, which is definitely okay. I mean, there's nothing wrong with that as long as it's diversified and they're comfortable with the volatility. But it doesn't sound like they are based on their question, because that is, while probably going to maximize your returns, it's also going to fluctuate more than something that's going to have some more stable investments in there, such as money market funds and short-term bonds and things like that. And that's really the crux of it is we want to talk to them about, well, first and foremost, is your plan blown up? Let's just talk about that first. Put everything in context. And yes, when I entered in the information that we had into our planning tools, the plan result came back at an 84%. And we like to say it's like, okay, probability of running out of money. Well, the way to think about that is like the probability of running out of money is kind of what it means, but it means you never made an adjustment ever. You just kept doing the same thing the entire time. And we run this out. We assume most people are going to be in, average or above average health. I mean, may not be the case for them, but I plugged it in at, they're going to live another 31 years.
Nice.
So it's 31 years of the same thing and no adjustments. And this was the goals that I entered: annual spending, $100,000 net of taxes, plus put our estimates in for healthcare expenses, which would be, come age 65, which will be soon for Karen, about $6,000 a year for both of them, which includes the Part B plus the kind of out-of-pocket stuff related to the Advantage plan. May not, that's our estimate on an annual basis. It could be slightly lower than that if they're not hitting all their deductibles. Also factored in the home remodel and the travel, $20,000 a year for the next 10 years. And that's with the plan result now comes in at 84. If you tweak things, and especially in times of market downtrends, those are conversations that we have. It's like, look, we set this up so that you have enough income, enough of the distributions that you need to pull out of the portfolio set aside to where you can get through, 5 years, 10 years or longer of a market downturn without having to sell any of the investments that could be down. That's the way to think about it. It's like, okay, you're hearing the news, you're seeing the Dow or the S&P or the NASDAQ or whatever going up or down, and you see your account balance, fluctuate too. It's like, well, what does that mean? It feels like, well, it's not good if it's less. And it can definitely feel that way. It's just, but let's look at it and really hone in on what impact does that have and figure that out. And if an adjustment to the allocation needs to be made, that definitely can happen. Again, we want to make sure those are done in the least emotional way as possible, not just reacting, but, sometimes that is just, hey, if it's going to feel better to make it more conservative, that's definitely an option. It's just understand the trade-offs with that.
That's right. Matt, when Matt says we're going to have enough set aside to get through, let's say, 5 years of someone's income needs, or he even mentioned up to 10 years. Each client is different. And when we talk about that, having it set aside, it simply means to have that in investments that will not typically fluctuate with the longer term capital equity markets. So short-term fixed income and bonds, like he mentioned earlier. And plus, remember, you're always going to have, if you have a balanced portfolio of stocks and bonds, you're always going to have dividends coming in mostly off your stock investments in most cases, if you own dividend paying securities, and then interest coming in off bond investments. That continues to come in no matter what the market is doing. Oh, there could be a dividend cut possibly here or there, but if you're investing in stocks that have solid long-term dividend growth ratios and good coverage ratios for debt, likelihood of that is relatively low. But remember, that comes in regardless of what the markets do, as well as now having what he said set aside, or an asset allocation that has money in fixed income, money market and bonds. And then when we speak of it that way, it's really interesting because we can talk to someone about these terms, a layperson that hasn't had a lot of training on the financial markets, and they can actually get their mind around that concept. Like, do you believe things will play out over time? Do you have some history? If you have your own personal history of building this wealth, it's really, really helpful too when someone has worked a lifetime, which is actually most of our clients that have worked a lifetime. They started with nothing and they've been through market ebbs and flows. They've seen the advance. They've seen where they've come from. It's actually quite astonishing for folks, and a great exercise is to look back at where you were 10 years ago or 20 years ago and see what you've been through, kind of reacquaint yourself with some of the things that have happened in the financial markets and politically and globally, and how you've made it through those difficult times, where you were and where you are today. That's a powerful exercise to bring perspective into how things might look going forward. But when you speak about it in terms of how much money we have in fixed income, how many years that of income we have set aside, so you don't have to sell something at a bad time, people can understand that. And we found it's a little easier to understand even than just throwing out saying asset allocation, stocks to bonds, these industry terms that some folks might not necessarily understand as clearly as just how much money do you have set aside so you could live your life while the markets are going through their inevitable downturns, which will continue to happen. Not only now this year, maybe they'll happen. And then in some cases, bear markets occur, throughout lifetime as well. 30-year retirement, of course, people will see volatility like that over a period of time. So I think it's really important to focus on how we think about that and how folks can get confidence in what they're doing going forward, and not only going forward, but thinking about where they've come from. It's really, really powerful.
One thing that stuck out to me as I was looking at this case study here is they said, we're thinking about whether we should go back to work or not. And as I read that, I thought, okay, here's a couple that is thinking about, we want to take control of the situation here. And so it just got me thinking about, well, what are other ways that we could communicate with them in a way that reflects their desire to have some level of control? So one way perhaps to think about this is you could create a matrix, and it could be a fear versus control matrix. So for example, if you think of like a 2x2 matrix, on the horizontal line, you could have control. And then on the vertical line, you could have fear. So in the bottom left where they intersect, there's like low fear and low control. And then going up to the top, it's high fear. And then going across the x-axis, it goes from low fear or low control to high control. And then you've got the 4 boxes there for that particular matrix. And so then you could think about, you could ask them to list, like, what are all your fears? What do you, as it relates to the markets, your portfolio, what's going on? What are your fears? So maybe come up with that list. So let's get them all on the table. And then you could say, okay, now I want you to like rank those fears from my biggest fear to my lowest fear. And then you could take that ranking and you could take each of those fears and you could plot them in one of those 4 boxes. So now we know what their fears are. We know how they prioritize those fears in terms of highest to lowest. And then by putting them in this 2x2 matrix, we can identify, okay, if it's a high fear and we have high control over the outcome of that fear, then there's particular strategies that we can do to help alleviate that fear because we have some control over alleviating the fear. Now we may have something where high fear, but low control over how we can deal with that fear. Okay. Then we've got to identify, okay, how can we deal with that as well? So I think by ranking the fears, by putting them in a control versus fear matrix, then we can specifically address particular strategies for each one of those. And that might bring some level of comfort. So for example, when they say go back to work, maybe that's a scenario. Hopefully that's not like the first thing that they would necessarily want to do, but maybe if there's a high fear, high probability, maybe going back to work is something that could be a particular strategy. It may not be the first go-to strategy, but if you put all this down on a piece of paper, that might be helpful.
Yes.
What are your thoughts on that?
No, that's exactly how we think about it and talk about it. Bill likes to say, control the controllables.
Yes. Right.
Because there are things that are out of our control. Market returns are out of our control. But what is in our control related? Well, it's our asset allocation. How much do we have in stocks versus bonds? How we react to markets is within our control. How much we spend. That's what we talk about, the spending and the spending plan as one of the biggest levers that people have with their financial planning. Taxes, policy, that's you can vote, but you ultimately don't have that much control over what happens when the government decides to make changes. So, let's focus on the things, primarily that we have control over. However, we can model in any, scenario, and common ones that we look at as people, this year there's been conversations about Social Security and what could happen with it. But that's not new to this year. I've been working with Bill doing this for 20 plus years now, and it's always been if Social Security is going to be there. I mean, I've heard that every single year the entire time.
I've been at 33 and a half, and I've heard it since then as well. So
yeah, and we've had clients that are retiring. They're like, they said that, we said that when we were in our 20s, 40 years ago. So it's like it's a thing that's just always been a question. But we can model that in. Like, how dependent is your financial plan on Social Security? We could say, let's just assume no Social Security. If you're at retirement age, like Jim and Karen, I think it's extremely unlikely that there's going to be some massive change to their Social Security benefits. But we can at least show that to them if they're, very concerned about it. There's not a whole lot you can do, especially at their age. I mean, unless going back to work is truly an option. That's more so when someone's younger and maybe more worried about it. It's like, okay, well, here's how much you can save to make up for that if that's a fear for you. But also looking at the budget, like we have the goal spending at $100,000 plus healthcare. Well, is there still some discretionary spending in there? Yes. Are certain pieces of that able to be, put on pause or deferred into the future and, started back up in a year or two? If that's, because that's where, again, the spending is going to have such a massive impact on the plan.
That's right.
Yeah. And I think this just totally points out the value of planning and working with a solid professional fiduciary financial advisor who understands what these scenarios are and understands how to plan for those scenarios. Like, for example, when I talk about this matrix idea, something that might be a high fear scenario is, well, what happens if we have a market crash? Yep. Well, that might be a high fear. Our ability to control that is like low to non-existent, meaning we can't control if the market's going to crash or not, but we can prepare for that. So we can do things like, to your point, we can have a high cash buffer. We can have 1 or 2 years sitting in cash of your spending needs so that we've got a long runway before we'd even have to consider doing anything with the actual investment portfolio. So by understanding that we know what could happen, we have a sense for the likelihood or non-likelihood of that thing happening, and we've got ways that we can prepare. So if someone is like super fearful of a market crash, well, there's things that we can do to help, lower the fear factor there.
Yeah.
And really demonstrate that. So, Yeah. And then again, running out of money might be another high fear thing. Lots of things that you can do there. As you mentioned, we could reduce spending.
Yep.
We could go back part-time work, that sort of thing. So that there's always variables. There's always levers.
Yep.
And sometimes it just takes an unbiased third-party person like a financial professional to point these things out and increase people's comfort level.
One of the things that you both have mentioned, rightfully, is that we cannot control market returns. So you both said that, and I agree. But here's let me throw another nuance on it for our listeners and viewers to just ponder this. Think about this. Steve, you said something just now that said, what happens if the market crashes? So let's say we go back to, and I lived through this as a professional, 08, 09, the financial crisis, or Matt has too, or 01, 02, and Matt was just getting in the industry back then. You remember 02, Matt, for sure.
Yep.
We'd gone through the tech bubble in 2000. Everybody thought the market was going to crash due to Y2K. That didn't happen, but then the tech bubble did occur, and then we had a lot of other things as well, including the towers coming down, 18 months into it in September of 2001. Yeah. So not a fun time, not a very difficult
and WorldCom time. Right after that, and Arthur Andersen helping them do it. I mean, it was...
So, yes, imagine, Enron, WorldCom, and one of the most trusted accounting firms, consulting firms caught, I suppose, helping them falsify their records. So now maximum distrust of the system. You think about going through those things, you talk about that. Well, if someone had retired just before that, and we had people that had retired just before that, still clients too, by the way, today, if they had enough set aside, set aside, what does he mean set aside? What we mean is out of the equity markets, so that you can live on that money, the dividends and the interest, while the market takes its time to come back. Even from something as deep as that was a 50% approximately correction in the broad markets that took a few years. It took a few years there to bottom out and then make its way back to the upside again. It happened again in 08. Interesting time frame that it would happen again just less than 4 or 5 years later. Same depth, maybe even more. I think the markets were actually down temporarily.
60,
and I always say that, temporarily, down temporarily. 60% or so, wasn't it, Matt, on the S&P? At the bottom there?
That's right, yeah.
Like March of 09. But if you had enough, if you were set up appropriately, you can get through just about anything. But you've had to have done your work up front. And when you say we can't control market returns, I would contend we can't control them short term. We can't control the short-term market returns. We can't control interest rates. We can't control or predict the short term. But what I will also say is most of your lifetime returns will come from your asset allocation by what you had in stocks compared to bonds, what the ratio was. And the more equities you have, the more stocks, the more great American companies, the great companies of the world that you own, and you're able to hold them long term, and you don't do one of two things: sell them because you need the money because you didn't have enough set in fixed income to get you through, or two, you panicked, you had a emotional reaction and sold things at a most likely the worst possible time. As long as you didn't do those two things, you had time for those equities to run the course. The more you have as a percentage of your total in equities, the higher your long-term return will be, most likely. The odds are highly favored or highly in your favor. The longer your time frame, the more equities you have, the more the total return will be. As long as you can get through those two things, you have enough in fixed income to pay you what you need to live on, and two, you don't have an emotional reaction and sell at a bad time, which really does blow the plan up. Matt mentioned earlier, is your plan blown up? Someone sells out at the bottom of the market of their equities, it's going to be really hard for them to get back on track. In most cases, we've seen folks get referred to us that have done that. That is a situation where things are maybe a little different. You got to do the best with what you've got at that point. But I would contend asset allocation is something you can control. So longer term, maybe you have more control over your returns than we think. Okay. Actually, I think you do, would be my opinion.
Yeah. You control how you allocate the funds. Exactly.
That's correct.
And how you react to them.
So you controlled that you had enough to get through those things because you've done the analysis. You've looked at what you've needed. You've sat down with a good fiduciary advisor. You've realized what the cost will be. You've been honest about the cost. You haven't gone into denial like, well, let's just assume our costs are this, but really they're way higher than you thought. There's times where that's why we have Matt does a whole webinar on retirement spending. We've just put one out recently. It's on our website, where you can look at what the real retirement spending may be, because certain expenses drop off when you retire. Others kick into play. I mean, inflation, we run it, I think, generally 3% on our broad costs, but we run healthcare at closer to 6%. Right, Matt? Because that's what they've inflated by. So that's what we're using as our assumptions. We have capital markets assumptions that we run in our plans that are less than historical to be the actual historical returns that have happened in the markets, that to be conservative. And we kind of look at a range of all these things. But it's the financial markets are much like kind of the opposite of going to the casino. The longer you're able to have a plan and let that plan mature and grow long term, the odds are so much higher in your favor that you will have a favorable outcome. The casino, the longer you play, you're nearly guaranteed to lose. So we go into a casino, you win first. That's a horrible thing that can happen. If you win first, think you have it figured out. You keep playing at the casino, you're eventually going to lose. In the equity markets, it's the opposite. The longer you play, the higher the odds are in your favor. And I hate even to use the word play, because now I'm comparing gambling to investing, which in long-term investing is way more than speculation or investing.
It's pretty boring, which is the opposite of gambling.
It's very boring. Long-term investing is boring because there's no, and I have a whole chapter in my book, second edition of my book, called Staying Away from the Next Flash in the Pan, where people are trying to kind of cut corners, get rich quick, find this, they're going to do that, meme stocks. One time it was pot stocks. I don't know. I went way back and looked at all the what I called flash in the pan ideas for people to cut corners. And they typically lead to, in fact, I ended the book with the tragic story of JFK Jr., where he actually tried to save 15 or 20 minutes on his way to Martha's Vineyard and killed both him, his wife, and her sister because he was trying to take a shortcut and wasn't qualified to fly over the ocean. So not to be dramatic there, but it is serious when you're talking about your life savings. Another issue too, I think is important, is when we run these models. When I got into the industry in the early 90s, the software we had just didn't have the computing power. So we had some software. You could run some analysis of cash flows, Social Security, inflation, things over time, market returns, but it was all kind of a straight line interest rate. It was better than nothing. But compared to what we have today, where we can run random sample, we can run thousands and thousands and thousands of simulations. We're assuming that the worst happens. We're assuming some of those simulations will have really poor market environments. They'll have multiple bear markets. We're not just testing for a straight line interest rate. I think it's important. I still know there's some financial firms out there that are running, like I heard one's running 7% straight line. We all have our way of analyzing things, and we want to help people find, ultimately at the end of the day, look at the resources that they have and say, how do you be a good steward of these resources so that you don't run out someday and you enjoy them as much as you can with the least amount of guilt and anxiety around it, and that you enjoy your resources. And you can look up at the end of life and say, I don't have any regrets about how I spent or how I didn't spend my resources because I was too scared or afraid. Also, because we talk a lot about this, but the good portion of our clients have more money at the end of their life than they've ever had in their life, like substantially more money at the end. And you might ask me, is that a success, Bill? And I would say, well, it's better than having no money. It's better than having run out. But
and not wanted to run out.
Yes. But having way more than you've ever had in your life at the end, I could maybe contend that there might be ways to say they maybe could have deployed their resources and enjoyed them more personally, family, charitably, other things. So a lot of this is, yes, spreadsheet answers, but then some of it, which is why I think the human element of that interaction between an advisor and a client, and especially an advisor that's been through it with thousands of families and seen the different aspects and can cull out what's important to folks and help them find that balance, is extremely valuable. And I think it's good to be talking about it today. We've gone through a little market volatility here, but really it's not that much, honestly. Like, it's a very typical year, what market volatility wise, but still honor and acknowledge folks' questions and concerns.
Yeah. Well, Bill, I think that's a great place to wrap this one up here today. I think just a quick summary here for Jim and Karen in this particular case is they've got pretty good assets here and pretty good probability that they're going to be fine. And even if things start going sideways here, there are some levers that they can pull in terms of how they could get back on track, whether it's reducing spending a little bit or maybe getting some part-time work. probably aren't going to have to do that because they're in a pretty good shape here. So guys, as always, appreciate it. And for each of you listening, to learn more about Keen Wealth Advisors, please visit us at keenwealthadvisors.com. And if you have not done so already, please subscribe to the podcast, Keen on Retirement. Please tell all your friends and colleagues about the show, as we would love to get more people listening to it as well. So guys, as always, appreciate you taking the time here to help spread financial literacy across the United States and the entire world.
Thank you, Steve. Thank you, Matt. Great show, guys.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.